If you try to manually track down and read through every single company listed on the US stock exchanges, your desk will look a little something like this. Right now, there are around 4,000 public companies trading in the US alone, and every single month, quarter, and year, they flood the market with their financial statements, massive balance sheets, income statements, and cash flow statements. If your plan is to be thorough and read all these documents one by one, honestly, good luck. You're going to need it. Technically speaking, these financial statements contain everything you need to analyze the company. The data is all there. But the process instantly becomes completely cumbersome when you have to scale it across thousands of options. So the real question is, can there be a better process? Can we cut through the noise, strip away the clutter, and filter out the thousands of companies that don't matter, until we are left with a clean shortlist of just 10 companies that actually deserve our attention? That is exactly what financial ratios do. So how do financial ratios actually pull off this magic trick? Think of financial ratios as your ultimate filtering tool. Instead of getting bogged down by raw millions and billions of dollars, ratios translate that massive wall of data into clean, manageable percentages, multiples, and proportions. They give you three massive advantages when you're analyzing the stock market. First, instant scale and comparison. Raw numbers lie. A company making $10 million in profit sounds huge, but if it took $500 million in revenue to get there, that's a very different story than a company making $1 million or $5 million of revenue. Ratios strip away the sheer size of a business. They let you put a multi-trillion-dollar tech giant side by side with a small cap stock and compare them on a completely level playing field. Second, trend analysis over time. Looking at a single year's financial statement is like taking a single snapshot, but businesses move. By tracking ratios quarter over quarter, you can see the true trajectory of a company. Is their profit margin expanding because they are getting more efficient, or are they quietly bleeding cash and relying on debt to survive? Third, the ultimate BS detector. Management can sometimes use creative accounting to make raw income or revenue look incredible on paper. But ratios connect different parts of the financial statement together, like matching up what a company owns versus what it owes, or what it earns versus how much cash it actually collected. When you run these checks, hidden red flags become glaringly obvious. In short, financial ratios take thousands of pages of corporate clutter, strip away the noise, and act as a fine-tooth comb. They help you toss out the thousands of companies that aren't worth your time, so you can focus entirely on the elite few that deserve a deeper look. Most beginners make the mistake of opening a company's financial statements first and getting lost in the weeds. The right process is exactly the opposite. You use ratios as your broad scale filter to scan the entire market, cut through the thousands of options, and narrow your list down to a handful of potential winners. Then and only then do you open up the actual financial statements of those shortlisted companies to do your deep dive research. Ratios don't replace financial statements, they make them manageable.